The term annual percentage rate of charge, corresponding sometimes to a nominal APR and sometimes to an effective APR, describes the interest rate for a whole year, rather than just a monthly fee rate, as applied on a loan, mortgage loan, credit card, etc. It is a finance charge expressed as an annual rate. Those terms have formal, legal definitions in some countries or legal jurisdictions, but in general, the nominal APR is the simple interest rate. The effective APR is the fee plus compound interest rate. In some areas, the annual percentage rate is the simplified counterpart to the effective interest rate that the borrower will pay on a loan. In many countries and jurisdictions, lenders are required to disclose the cost of borrowing in some standardized way as a form of consumer protection. APR is intended to make it easier to compare lenders and loan options. Multiple definitions of effective APR. The nominal APR is calculated as the rate for a payment period multiplied by the number of payment periods in a year. However, the exact legal definition of effective APR or can vary greatly in each jurisdiction, depending on the type of fees included, such as participation fees, loan origination fees, monthly service charges, or late fees. The effective APR has been called the mathematically true interest rate for each year. The computation for the effective APR, as the fee plus compound interest rate, can also vary depending on whether the upfront fees, such as origination or participation fees, are added to the entire amount, or treated as a short-term loan due in the first payment. When startup fees are paid as first payment, the balance due might accrue more interest, as being delayed by the extra payment period. There are at least 3 ways of computing effective annual percentage rate: by compounding the interest rate for each year, without considering fees. Origination fees are added to the balance due, and the total amount is treated as the basis for computing compound interest. The origination fees are amortized as a short-term loan. This loan is due in the first payment, and the unpaid balance is amortized as a second long-term loan. The extra first payment is dedicated to primarily paying origination fees and interest charges on that portion. For example, consider a $100 loan which must be repaid after 1 month, plus 5%, plus a $10 fee. If the fee is not considered, this loan has an effective APR of approximately 80%. If the $10 fee were considered, the monthly interest increases by 10%, and the effective APR becomes approximately 435%. Hence there are at least 2 possible effective APRs, 80% and 435%. Laws vary as to whether fees must be included in APR calculations. United States. In the U.S., the calculation and disclosure of APR is governed by the Truth in Lending Act and Regulation Z of the Act. In general, APR in the United States is expressed as the periodic interest rate times the number of compounding periods in a year, since the APR must include certain non-interest charges and fees. It requires more detailed calculation. The APR must be disclosed to the borrower within 3 days of applying for a mortgage. This information is typically mailed to the borrower, and the APR is found on the Truth in Lending disclosure statement, which also includes an amortisation schedule. The Truth in Lending Act of 1968 resulted in honest reporting of effective APRs for more than a decade. Then in the 1980s, automakers began to exploit a loophole in the Act and its implementing regulations. Since the Act does not precisely define finance charge or total sale price, automakers found they could reduce finance charges and increase car prices much as they wanted, provided total sale price was not changed. APRs calculated with the reduced or eliminated finance charge became the below market rate, and 0% APR loans that were commonly advertised for the next 30 years. 0% APR or $1,000 rebate is the most common form of these deceptive loans. The rebate is the hidden finance charge, reclassified to car price. If the consumer doesn't accept the 0% loan, then he or she does not accrue the extra $1,000 interest on that loan, and this $1,000 is represented as a rebate. In reality, there is no rebate and no 0% loan. Automakers have been aided in this ongoing consumer deception by the regulators who administer TILA. The current form of disclosure under TILA seems designed specifically to support the automaker's deceptive scheme. Administration of TILA was recently transferred to the new Consumer Finance Protection Bureau, which may give cause for hope of reform in the act and its administration that will restore the consumer protections intended when TILA was enacted. On July 30, 2009, provisions of the Mortgage Disclosure Improvement Act of 2008 came into effect. A specific clause of this act refers directly to APR disclosure on mortgages. It states, if the final annual percentage rate APR is off by more than 0.125% from the initial GFE disclosure, then the lender must redisclose and wait yet another 3 business days before closing on the transaction. The calculation for close-ended credit can be found here. The calculation for open-ended credit can be found here. Office of the Controller of the Currency APR Calculation Software. European Union. In the EU, the focus of APR standardization is heavily on transparency and consumer rights. A comprehensible set of information to be given to consumers in good time before the contract is concluded and also as part of the credit agreement. Every creditor has to use this form when marketing a consumer credit in any member state, so marketing different figures is not allowed. The EU regulations were reinforced with Directives 2008/48 EC and 2011/90 EU, fully in force in all member states since 2013. However, in the UK the EU directive has been interpreted as the representative APR. A single method of calculating the APR was introduced in Directive 98/7 EC and is required to be published for the major part of loans. The basic equation for calculation of APR in the EU is where M is the number of cash flows paid by the lender, L is the sequence number for the cash flows paid by the lender, SL is the cash flow in period, LN is the total number of cash flows paid by the borrower, K is the sequence number of the cash flows paid by the borrower, VAC is the cash flow of period K, and TL and TK is the interval, expressed in years and fractions of a year between the date of the first cash flow and the date of cash flow L or K. In this equation, the left side is the present value of the drawdowns made by the lender and the right side is the present value of the repayments made by the borrower. In both cases, the present value is defined given the APR as the interest rate. So the present value of the drawdowns is equal to the present value of the repayments, given the APR as the interest rate. Note that neither the amounts nor the periods between transactions are necessarily equal. For the purposes of this calculation, a year is presumed to have 365 days, 52 weeks or 12 equal months. As per the standard, an equal month is presumed to have 30.41666 days regardless of whether or not it is a leap year. The result is to be expressed to at least one decimal place. This algorithm for APR is required for some but not all forms of consumer debt in the EU. For example, this EU directive is limited to agreements of €50,000 and below and excludes all mortgages. In the Netherlands, the formula above is also used for mortgages. In many cases, the mortgage is not always paid back completely at the end of period N, but for instance when the borrower sells his house or dies. In addition, there is usually only one payment of the lender to the borrower in the beginning of the loan. In that case, the formula becomes where S is the borrowed amount or principal amount, A is the prepaid one-time fee, R the rest debt, the amount that remains as an interest-only loan after the last cash flow. If the length of the periods are equal, then the summations can be simplified using the formula for a geometric series. Either way, the APR can be solved iteratively only from the formulas above, apart from trivial cases such as n equals 1. Additional considerations: confusion is possible in that if the word effective is used separately as meaning influential or having long-range effect, then the term effective APR will vary, as it is not a strict legal definition in some countries. The APR is used to find compound and simple interest rates. APR is also an abbreviation for annual principal rate, which is sometimes used in the auto sales in some countries where the interest is calculated based on the original principal, not the current principal due. So as the current principal due decreases, the interest due does not. Rate format. An effective annual interest rate of 10% can also be expressed in several ways. 0.7974% effective monthly interest rate, because 1.0079741 equals 1.1. 9.569% annual interest rate compounded monthly, because 12 times 0.7974 equals 9.569. 9.091% annual rate in advance, because divided by 1.1 equals 0.091. These rates are all equivalent, but to a consumer who is not trained in the mathematics of finance, this can be confusing. APR helps to standardize how interest rates are compared, so that a 10% loan is not made to look cheaper by calling it a loan at 9.1% annually in advance. The APR does not necessarily convey the total amount of interest paid over the course of a year. If one pays part of the interest prior to the end of the year, the total amount of interest paid is less. In the case of a loan with no fees, the amortization schedule would be worked out by taking the principal left at the end of each month, multiplying by the monthly rate and then subtracting the monthly payment. This can be expressed mathematically by where P0 is the initial principal, R is the percentage rate used each payment, N is the number of payments. This also explains why a 15-year mortgage and a 30-year mortgage with the same APR would have different monthly payments and a different total amount of interest paid. There are many more periods over which to spread the principal, which makes the payments smaller, but there are just as many periods over which to charge interest at the same rate, which makes the total amount of interest paid much greater. For example, $100,000 mortgaged over 15 years costs a total of $193,429.80, but over 30 years, costs a total of $315,925.20. In addition, the APR takes costs into account. Suppose, for instance, that $100,000 is borrowed with $1,000 one-time fees paid in advance. If, in the second case, equal monthly payments are made of $946.01 against 9.569% compounded monthly, then it takes 240 months to pay the loan back. If the $1,000 one-time fees are taken into account, then the yearly interest rate paid is effectively equal to 10.31%. The APR concept can also be applied to savings accounts. Imagine a savings account with 1% costs at each withdrawal and again 9.569% interest compounded monthly. Suppose that the complete amount including the interest is withdrawn after exactly 1 year. Then, taking this 1% fee into account, the savings effectively earned 8.9% interest that year. Money factor. The APR can also be represented by a money factor. The money factor is usually given as a decimal, for example, 0030. To find the equivalent APR, the money factor is multiplied by 2,400. A money factor of 0.0030 is equivalent to a monthly interest rate of 0.6% and an APR of 7.2%. For a leasing arrangement with an initial capital cost of C, a residual value at the end of the lease of F, and a monthly interest rate of R, monthly interest starts at CR and decreases almost linearly during the term of the lease to a final value of FR. The total amount of interest paid over the lease term of n months is therefore, and the average interest amount per month is this amount is called the monthly finance fee.